Hey, what's going on Instagram? It's Sam here, and I know last week was my first one of the new Monday mortgage melt that I'm doing, but because it was bank holiday, maybe I didn't time this particularly well. Today is the Tuesday mortgage melt. Doesn't quite roll off the tongue, does it, as nicely as Monday mortgage melt. But next week we'll be back to Monday. We're just doing a special today because I was away during the weekend and didn't do a live yesterday. So here we are on Tuesday. The premise of these live videos is to give you all a bit of an update as to what's going on in the mortgage and property finance world over the last 7 days. Some of the stuff that I've seen, some of the sort of interesting cases that we're involved with and we're seeing, and really to answer any questions that you guys have got. So there's a couple that have come up through other social media channels, and I'll be asking you later whether you think we should remain on Instagram or whether it would be better to try other channels like Facebook or even YouTube potentially. But look, let's kick things off with something really interesting from the last week, which is we've seen our first kickback from a lender with regards to loads and loads of questioning with regards to mortgage holidays, civil loans, bounce back loans, this sort of stuff. And it came from our friends over at Vida. Now, Vida have been in the news recently because they were the first mortgage lender to come back with an 85% buy-to-let mortgage for limited companies. And so, hello everyone who's joining, by the way. And so they were sort of in the news for that. That is the lender who have come back straight away. So as much as they seem as though they're perhaps not kind of being as, or they're kind of taking a bit of a risk, if you like, in terms of going to a certain direction with the market, they quite clearly are not as risky as we first thought that they were, because they're the first lender that we've really seen their underwriting come back with a ton of questions concerning whether our applicant had any of the civil loans or anything like that in place. Now, we went back and we asked them a little bit more about this and sort of what their line of questioning was all about. And essentially really what it was that they're not, it's not a deal breaker. So don't worry too much if you've taken out payment holidays, if you have civil loans, if you've taken out bounce back loans. It's not something that's going to be, the thing that stops you from getting a loan. It's or your application is going to be declined, but it could be the straw that breaks the camel's back. If it's a bit of a risky case anyway, if it's a high loan to value, this one we're looking at is only 75%. So it's not necessarily a deal breaker. But one thing I would say is, be open and honest. This is a real key that we've seen or we see anyway in our line of work, is you've always got to be honest with lenders. Don't try and hide anything, because to be honest with you, if you're found to have lied to a lender, it's worse than giving them the bad news in the first place. They'll see it as you purposefully trying to mislead them, and likelihood is that the underwriter may well just decline the case on that basis anyway. So it's always important to be really, really upfront. So if you have taken out a civil loan, if you have taken out a bounce back loan, if you have had payment holidays, keep a really thorough record of all the details, and have a story, your reason for taking out this bounce back loan. For a lot of lenders, just taking it out because it was available is not necessarily going to be something they really want to hear. But if it's the honest truth, then try and at least work it into something that's real. When it comes to the payment holidays, and this is something that I've been talking about all throughout lockdown, and that is if you've had a payment holiday of one. Hi Simon, thanks for joining. You had a payment holiday on any of your buy-to-lets, even if it's on your main residential mortgage, on anything at all. If you can, please try and either stop it now, so stop your payment holiday, or if you've already stopped your payment holiday, get back up to date with the repayments. Because if you think about it, if you've gone 3 months without making a payment, you're technically 3 months behind. It's not a holiday per se, it's a bad use of the word holiday. It is that you are in arrears, essentially. So you need to clear that back to where it was. And actually, if we can go back to a lender and say, or you can go back to a lender and say, as part of your application process, I did have a payment holiday, but I'm up to date now. I've paid it back in full. I'm not using it anymore. That's going to look good. You've taken responsible action. lenders are quite understanding with the fact that these payment holidays became extremely easy to get hold of, and so a lot of people took them even naively potentially, and that they didn't really need to take them. But if you get yourself back up into sort of where you are, back up to date, that's really going to help. And that's certainly what we're doing with this particular client, where things are a little bit in arrears. So a bit of a big change that we've seen in the mortgage market over the last sort of 7 days or so. Another thing, and again, I sound like I'm a broken record with this, is getting a lot of inquiries to do with using mortgages to buy properties where you're only going to have the property for a short period of time, or you're only planning on having that particular mortgage for a short period of time. Yes, I am talking about the buy, refurbish, refinance model. And by the way, the buy, refurbish, refinance model is not just for buying a home or a single family home, family property, residential house, and improving it and then selling it on or renting it as a home. It could be anything. It could be converting a property into an HMO. It could be converting a property into a serviced accommodation. It could be converting a commercial property into some residential flats. Anything where you are taking one thing, you're converting it, changing it, adding value, and it comes out as another, effectively is the buy, refurbish, refinance model. Now, if you're buying using a long-term mortgage, you are effectively, like I said earlier, in terms of you not doing the right thing, you're purposefully misleading a lender. If you say to any mortgage lender, if you went to, I don't know, Kent Reliance or something like that and said, hi guys, I'm applying for this mortgage for 25 years on a 5-year fixed rate. Oh, but I'm probably going to pay it back in 6 months' time because I'm going to add value to it and then I'm going to refinance it to another lender. Guess what they're going to do? They are going to decline your application. It's as simple as that. So if at any point you're saying something to purposefully mislead a client, purposefully mislead a lender, you need to really think about this. It's really important. And I actually had a call today from a potential client who has been, and I'm going to get annoyed now a little bit, because he's been instructed or advised by an experienced property investor who is acting as a mentor for this particular client, and has actually told them that they could buy a property using a mortgage. This particular property, it's a tart and turn, but they are going to be doing some structural work to it, potentially an extension out of the back. That's not a mortgage, If you buy a property and use a buy to let mortgage, it's not called a buy to let mortgage just for fun. And it's definitely not called a buy, do some work to it, maybe some paint, a new kitchen and an extension off the back and then let it mortgage. It's called a buy to let mortgage. They're expecting you to let it straight away. If anything is going to hinder that ability to sort of rent it straight away, you have to think about whether a mortgage is the right product. And in many cases, it isn't the right product. And what annoys me about that particular case is purely the fact that somebody who actually has a lot of experience is giving that kind of advice. Now, I've got a question that's come through. Can you have 2 properties on consent to let at the same time? I work as a contractor and move homes a lot. The answer to that, actually, Blix, is yes, you can. However, what I would say, and funnily enough, I saw a client last week, and I'll tell you a little bit about what we're planning on doing with them in a second because it's pretty relevant. But if you are getting to the point where you've suddenly got more than one property that's on a residential mortgage and on a consent to let, yes, they're probably on they're probably on repayment mortgages, which is a good thing. You want to be paying down your debt. But you're probably either making a loss or you're not making very much money off of those properties at all. And this good opportunity to share this with you, Blix, is that we saw a client last week. He's got a property that's consent to let, and he was looking to purchase a new main residence for themselves. And I said, look, you've got X amount of money over here to put towards your new main residence. Based on that, we're going to need an 85% loan to value mortgage. At the moment, anything above 75% on a residential mortgage is starting to get pretty heavy fee wise and interest rate wise. So I said, well, look, you've got this other property. Now, he'd only just refinanced it with Nationwide, who had given him consent to let. And this is the point of what we're talking about here in terms of having too many properties that are consent to let. Why have them sitting on a consent to let? With this particular property, yes, we'd have to pay a small early repayment charge in order to change the mortgage. But what we're looking at is actually refinancing that property that is being let out onto a buy-to-let mortgage. Interest rate's still not too bad at all. And we're taking it to 75%. Now, there are a few things that are really, really going to help this client as a result. And this is when you have to start thinking outside the box. Yes, we're going to have to pay nearly $2,000 as an early repayment charge. That's going to be just added onto the loan with the new lender. He's only, I think he's only leveraged at about 67% at the moment because he's been making repayments. We're going to take that up to 75 and we're going to pull some money out. Now, what happens is that mortgage is now on an interest-only basis. He's now, instead of making a loss every month, he's actually making a profit of over £400 net after everything. He's also got an extra 15 grand to put into his deposit for his main residence. And guess what? That means a few things. Number one, it gets him down below the 80% bracket, which means we're going to save probably 0.5% on the interest rate. He's actually going to be borrowing less on that residential mortgage. And if you've been following me for any length of time, you're going to know that I'm big on telling people to get rid of their residential mortgages as quickly as they can. It's your biggest liability. Get rid of it. Now, the other thing that's great with that is that he's now, because he's actually making a profit on that buy-to-let mortgage, he can either do one or two things. He can either put that money towards the payment of his residential mortgage each month, which means his outlay is half of what it would have been, or he uses it to make an overpayment, which means he's effectively paying down that residential mortgage at a third quicker than he would have done. In fact, with the compounding effect, it's going to be much, much quicker than that. We're going to get rid of that in only a few years instead of the 25 or 30 that he's signed up for. So, Blix, I know that was a kind of a weird way of answering your question about whether you can have consent to let with two separate properties. You can, but my question back would be, why would you? There's got to be a better way of dealing with this so that the overall proposition of what you have actually works out better, especially if you're moving. You've got those two properties on consent to let at the moment. Hey, Katrina, thanks very much for joining us. And Andriano, so I didn't say hi to you guys. If you are moving about a bit and you've got two properties that are on consent to let, why not have a look at one or both of those and see whether actually they can be refinanced onto standard buy-to-let mortgages, where the money could be pulled out and put towards your next residential mortgage. This is what we call structuring your finance, in a clever way. Actually looking at things from a different perspective and actually going, yeah, do you know what? I could shift some debt from here to here, even if the interest rate is a little bit higher. Getting rid of the bad debt, and this is where we delve into what is good debt, what is bad debt. We could probably talk about this all day long, but to be honest with you, buy-to-let mortgages are good debt. Someone else is paying those off for you, or at least they're paying the interest for you, and you're probably making a profit. A lot of people will buy a buy-to-let property, or a lot of my clients buy buy-to-let properties, and they don't actually take an income from them. What they do is every 2 or 5 years, depending on when, hey Fash, nice to see you, depending on when they're going to be refinancing, actually sit with the profits there, and then they'll pay off a lump sum. So let's have a little look. We've got a few more questions that have come in. M10 Noj. Change it to consent to let to buy-to-let product, then stamp duty would need to be paid. No. That's not the case at all. If you were moving it into a limited company structure, then yes, that is absolutely true, M10. This is actually quite a good thing to talk about here. If you're actually converting a property from a personal name to limited company, chances are, so it's all about understanding the kind of transaction that we're looking at here. The transaction we're looking at is not a transfer of assets. That would be from one limited company to another. We're actually looking at a sale and purchase transaction. That means because the limited company is essentially purchasing, if I can get my words out, purchasing the property from you, even if you are the ultimate beneficiary owner, stroke director, stroke shareholder of that business, and it acts as a sale and purchase transactions. Unfortunately, that's when we have to pay stamp duty. So no, if you change it to a buy to let from consent to let, You won't be paying stamp duty unless you change the ownership structure, which most people wouldn't do. So hopefully that answers your question there, M10. Blix is back with another question. Can you leave a residential mortgage to go to buy-to-let within 2-year fixed rate period? Yes, you can. You will need to pay an early repayment charge, as I mentioned before. But if you factor all of it in together, then a lot of the time it can still work out better. It's all about having a little think about how you can restructure things in a better way. For this particular client that I was discussing earlier on, this is where you're thinking, right, okay, I'm paying money here, I'm paying money there, but how can I actually shape those up to make it make sure I'm paying the most off, or I'm getting the most from my money in both sides. And in this instance, even adding $2,000 to the mortgage, he's still going to release more money in order to have a lower loan to value residential mortgage, that's exactly what we're going for. We want that to be zero as quickly as possible. But we also then change things up. So then you go to basically you're going from not making any money on one because you're paying a repayment to actually making a profit on this buy-to-let and transferring that money over so that you can use that to contribute towards the cost of your new mortgage, which is great. Vivi, any advice on which mortgage provider will provide a buy-to-let to a company with less than 1 year's trading? Yes, it's a really, really tricky one. There are a couple of lenders. I believe we could see I've done one of these recently. Foundation did the mortgage for the client, but there was a sort of extenuating circumstances with anything. Vivi, we have to have a bit of a story attached to it, essentially. So this particular client, unfortunately, there was a loss of a family member, which means that he and his sister ended up moving in together. And he ended up letting his property that he was living in out and got consent to let. We refinanced that based on the fact that the overall thing, he had to leave his job. Hey TJ, he had to leave his job. So the lender could see the overall story made sense. He had some other property in the background. There aren't very many lenders out there that will lend with no trading history at all. This is why I always say to people, when you're going to give up your job and you want to go into property full time, think about it, because from a lending point of view, it can have a real negative effect, unfortunately. So always have to think about what the repercussions would be if you give up your job. If you don't have a year's worth of accounts for your property business, for example, that could be something that could really, really cause a lot of problems, especially if you don't have a real kind of story behind it like this particular client had. So I hope that kind of answers your question a little bit, Vivi. M10's back. Sorry, if residents mortgage to buy to let, there will be stamp duty. No. So it's all about the ownership of the property. Do you own it in your own name, or do you own it as a limited company or an LLP or something else? If transitioning like that, when you're changing the ownership to coincide with the mortgage, that's when there will be stamp duty paid. If it's your own main residence, own name, and then you're going to buy a property and it's going to be in a limited company, if you're going to transfer the mortgage to buy to let in limited company name, then yes, you pay stamp duty. But if you keep it as just your own name, it's just two different types of mortgages. That's all. It would probably go down as what we call a consumer buy to let mortgage, which means it's actually regulated by the FCA. So there's a few little extra bits of paperwork that we need to fill out whenever the FCA get involved, but it's a relatively standard operation. Katrina, hi. Do you have any advice on getting a buy-to-let mortgage as an expat? Yes, buy-to-let mortgages as expats. It was a shrinking market. Not to bore you with the history, but a few years ago, this is so ironic as well. A few years ago, we had from Europe some new kind of regulation that came in that effectively actually made it harder for lenders to lend to anyone that wasn't either based in the UK or getting paid in pounds sterling. So you see the irony of that regulation coming in from Europe, which I think is pretty funny. But there we go. Overnight, the likes of Barclays, Santander, a lot of these lenders that were lending to expats just stopped. Santander are one of the lenders that lend to people that don't necessarily earn in pounds sterling, but they're few and far between now, unfortunately. So one of the few things that I would say to you, who is it that actually came up with the question, Katerina? Few things. Having being a homeowner is really, really important. Buying in a UK limited company can help because it gives you that sort of UK base. The fact that the limited company is brand new is absolutely fine. That's not a problem at all. But having that certainly helps. Having solicitors that maybe have a presence in each country. So if you were based in Switzerland, for example, and there was a solicitor that we were using in London for your UK transaction, if they had a relationship with somebody in Switzerland, that'd be really helpful. Otherwise, a local notary public is going to be required to sign all of your documents. Now, a lot of these lenders will want to see, just as a heads up, original signatures. So what this means is that they are going to have you're going to have to go and sign a load of documents, including copies of your passport, whatever. Take it to a local notary public, which is like somebody who can sign that documents are what they are, local to you. They will then have to, by recorded delivery, send them to your solicitor in the UK, and they'll have to have wet signatures on them, original signatures. That's one of the things that's really important. Now, in terms of getting a mortgage, we're talking just mainly there in terms of other bits and pieces, but in terms of getting a mortgage on that, you're looking really, best case scenario, you're looking somewhere between sort of 3 and 4%. They are a little bit more expensive because lenders are fewer and further between. Now, if you're okay with getting a sort of a Sharia compliant, which is sort of an Islamic mortgage, which, to be quite honest with you, are very, very similar in all aspects to a standard mortgage. It's just the way that the everything's sort of written up. Then there'll be a few more options for you with the likes of Gatehouse, Al Rayyan, these kind of lenders who are quite happy to lend to UK expats and offer pretty decent and good rates. And again, it's all the other thing is experience. If you've got some properties that you're already renting out, even if they're not in the UK, that's really, really going to help you in this instance as well. So that's what I'll be looking at, Katerina. But I've got another question that's just popped up into my box by Blix again. I want to buy a new property every 8 months as I change locations for work. Any issues getting consent to let, I presume that says. Yeah, I'm just going to take that off. So you might start to see a bit of an issue. It's a bit of a grey area, this. Lenders, whenever they start seeing a pattern with things, sometimes it can worry them. So for example, if you go and buy a new property, get a new residential mortgage, one thing that is going to happen is lenders are going to look at your credit file. That's how they do it. Some do it through my battery, just telling me that it's not got long left to go. If I can get my words out. And essentially, if you can see a certain trends, so you're buying a property on a residential mortgage, and then suddenly you're buying another one on a residential mortgage 8-9 months later, maybe some lenders will start to sort of decide against lending to you. I don't think it's going to cause you major problems until you probably get to 3 or 4, but it could start causing you issues. People think that lenders don't look at credit files. They do. And in fact, this is something that's really, really interesting. Did you know that lenders on the whole don't actually see your credit score? So when you sign up to Experian or Equifax or Credit Karma, whatever it might be, they don't pull through the score that you give them. They just pull the information through on the report. They create their own score internally. So don't get too hung up about what your score looks like. It's the stuff that's actually on the data that's held on your report that's really important. And this is the point here. If you're basically using a mortgage not necessarily in the right way constantly, it's something that could start holding you back. This is why, as I was saying earlier on, it might need to be that you look at refinancing these mortgages onto buy-to-let mortgages as soon as you can, because that it might start causing you a few problems further down the line. Adriano, compare the market doesn't show interest rate of 5% plus lender fees. Is it best to speak to a broker for this? I mean, always, let me see, I think you might have a question further back from that. Do you know any sites that give comparison of interest rates, particularly for limited companies? Now, I would definitely sort of say try and shy away from some of the comparison sites. Yeah, do you know what? For something that's pretty basic in terms of just, right, I need a new 60% residential mortgage, you know, compare the market, all that kind of stuff, great. When you start factoring in some tricky things like limited company ownerships or HMO and stuff like that, those sites are really a bit of a landmine. One of the other things as well is they do have sponsored lenders, so you know certain lenders will figure higher up on the list because they pay to be there. The best thing you can possibly do is get advice from a broker. Now, anyone that follows me know I don't sell myself online. But I am a broker, so you are asking the right people. In terms of picking a broker though, make sure that when you do find a broker, they are, like I am, directly authorised by the Financial Conduct Authority. It means I don't have any restrictions to the lenders that I can use. A lot of brokers have just a network or a panel of lenders that they work to, which does mean that you might be out. You know, the more specialist you get, you might be missing out on one of the best rates out there. So always speak to a broker and always see if you can find out whether they're it used to be called whole of market, but now we're not allowed to use that term. Unrestricted access, directly authorised by the FCA. If you're looking for a broker, you want to make sure that they fit that description, especially when you're looking for something a little bit more specialist and Giano. So that would be my advice there. Another question popped in. We might have to make this the last one. Are there any signs of lending tightening up, or are lenders still confident in the housing market? Good question. So the one thing that we've seen as a trend over the last sort of couple of months is there's starting to become a really big difference in the interest rates on something that's below 75% versus something that's above 75%. Now, I'm no economist by any stretch of the imagination, but what I do know how to do is take some information and stick it into my head and try and figure things out for myself. Now, there's always a contingency with these things. So in my book, what I'm thinking is the mainstream sort of lender market are probably saying, right, set up to 75%, i.e. a 25% equity, 25% deposit, we're looking relatively safe. We can afford to charge relatively low interest rates. When it goes above this, they're a little bit more concerned, and these lenders, these types of loans are deemed to be higher risk, and by quite a margin because the interest rates are higher. So this would suggest to me that lenders believe that we are on our way to seeing a dip, but they don't believe we're on our way to seeing a crash. There is a difference. So if you think that they're adding maybe a 10 or 15% contingency into that, that says to me that on the whole, lenders are probably predicting a maximum of a 10% dip in the market in reality. I don't know what we're going to see, to be quite honest with you. If you'd asked me 2 months ago, I probably would have said 5%. I am starting to question that, and I'm thinking maybe it might go a little bit higher. But do you know what? With it, in every adversity, there is opportunity, and if prices are going to go down on the whole, that just means that there's going to be a ton of opportunities for investors and developers to get hold of some really, really great deals. Right, a couple more questions. These are going to be the last ones because I've got to head off. I've still got a ton of work to do today. So, how to scale a BRR strategy with 150,000 cash. Right, okay, fun. This is a good question. So, BRR, buy, refurbish, refinance. Now, what I would do is I would actually split that 150. I would have a pot that would be as part of my investment strategy, which is your buy, refurbish, then refinance and keep. The perfect person to talk about this has just come on, Emma. So I would split that 150 into an investment pot. That is going to be your buy, refurbish, refinance. And I would split a portion of that into my trading pot. And this would be my buy, refurbish, and sell. Now, the reason why I would do that and not just continue on with the hi Emma, I wouldn't just continue on with the with 150 and just keep going, is because chances are with BRR, you're not going to pull every single penny that you put into that deal back out again. So with every deal you do, you're leaving a bit of money in, do another deal, leaving a bit of money in, doing another deal, leaving a little bit of money in, doing another deal. Eventually, you're not going to have enough to continue doing that. The whole purpose of this is you want to continue doing it indefinitely. So if you actually split your property company into two, an investment company and a trading company, and you flip properties, you keep replenishing your investment pot. That money goes into that. And guess what actually happens? And this is you reach this incredible tipping point. And I've seen so many of my clients do it, and it gets me really excited when it happens. To start off with, you're flipping properties over here to move money, continually move money back into your investment pot, so you continue to, recycle that cash. But every single time you buy a property, Jake, what you're doing is you're also increasing your cash flow through your investment. Now, if you're clever, you keep your day job, you keep your business alive, whatever it is you're doing over here, and you don't take money out of your property pot, because guess what happens then is you continue to take money out of the investments, the trading side, but you continue to also make more and more money on the investment side as well. So you can then start doing either bigger deals, or you can do more of the same deals, and you can overlap them, and then suddenly you see this exponential growth in the investment side of your business. And it might mean that you then get to the point where you can do some more sexy stuff like commercial to residential conversion, mixed use, HMO, serviced accommodation blocks, whatever it might be, converting a house into flats, all this kind of stuff. So all that starts by basically deploying your starting pot correctly. And look, Jake, 150 grand is a nice little pot to start with, so I think that's great. But yeah, I would split them down the line, and I would create two separate parts of my business, which is what I see some of my best clients doing. But that's got to be there. I'm afraid I've got to stop there because Grand Union Finance doesn't run itself. I am quite fortunate that I have my amazing business partner Engin in the office in London. With our new starter today, we had our new operations manager starting today, Ruby, who is absolutely awesome, and I can't wait for her to really help us grow our business rapidly. So I'm going to get back to it. It's been an absolute pleasure answering all of your questions today, guys. Really love it. Ping me some messages with any other questions that I've missed out on. I can do them next week. I am going to trial and see, I'm going to ask some questions whether people want to continue for me doing this on Instagram, or whether it would be better on Facebook or maybe even YouTube. But it will be every single Monday. Usually it'll be the Monday mortgage melt, but because it was bank holiday, we did Tuesday mortgage melt. Don't forget to go over and check out my YouTube channel, youtube.com/Sam Norris, the Property Investors Broker. There's a link in my bio. Lots of videos coming out weekly for you to get your teeth into there. But for now, thank you so much for joining me this afternoon. I hope you have a cracking week, and I'll catch you soon. Cheers, guys. Bye.